Imagine this. Two friends invest the same $1,000. A year later, one is thrilled with big returns. The other, anxious, frustrated, maybe even losing sleep. What's the difference? It all comes down to something you might not think about enough. Risk tolerance. In today's video, we'll break down what risk tolerance really means, why it matters, and how to discover your personal level before making big financial decisions. Let's dive in. Section 1. What is risk tolerance? Risk tolerance is your ability, emotionally and financially, to handle the ups and downs of investing. It's how much risk you're comfortable taking with your money without panicking or making poor decisions. Think of it like a roller coaster. Some people love the thrill, the highs and lows. Others prefer a calm, steady ride. Neither is right or wrong, but you need to know which one you are. Because investing without knowing your risk tolerance is like riding a roller coaster blindfolded. You'll panic the second it drops. Section 2. Why risk tolerance matters. Now here's the key. Understanding your risk tolerance helps you choose the right investments. Stick to your plan during market dips. Avoid emotional decisions that hurt long-term results. Let's say the stock market drops 20%. If your risk tolerance is low, you might sell everything in fear. But if you had chosen safer investments in the first place, you wouldn't feel the urge to panic. And if your tolerance is high, you might even see that drop as a buying opportunity. This one decision, knowing how much risk you can take, can be the difference between building wealth or losing sleep. Section 3. The 3 types of risk tolerance. Let's talk about the 3 main types of risk tolerance. 1. Conservative, low risk. You're very cautious. You value safety and stability over high returns. You'd rather earn 3 to 5% consistently than risk a 20% drop. You might prefer bonds, CDs, dividend-paying stocks, stable index funds. 2. Moderate, medium risk. You're okay with some risk if it means better returns. You want growth but not too much drama. Your portfolio might be a mix of stocks and bonds, index funds, ETFs, real estate. 3. Aggressive, high risk. You're comfortable with volatility. You focus on long-term gains and aren't scared by dips. You might invest in growth stocks, crypto, tech startups, emerging markets. Important note, this isn't about being reckless. It's about knowing your strategy and staying consistent. Section 4. Factors that affect your risk tolerance. So, what determines your risk tolerance? It's not random. Let's break it down. 1. Age. Younger people can usually take more risks. They have time to recover. Older investors often prefer safer investments to protect their wealth. 2. Income and savings. If you have steady income and emergency savings, you can handle more risk. Living paycheck to paycheck? You'll want to play it safer. 3. Financial goals. Saving for a house next year? You'll need stable, low-risk investments. Saving for retirement in 30 years? You can afford to take more risks now. 4. Personality. Are you calm during uncertainty? Or do you lose sleep if your money drops in value? Knowing your emotional reaction is just as important as your math skills. Section 5. How to discover your risk tolerance. Here's how to find your true risk tolerance. Step 1. Ask yourself these questions. How would I feel if my investments dropped 10% overnight? Would I sell, hold, or buy more? What's more important, peace of mind or maximum growth? Could I handle not touching this money for 5, 10, or 20 years? Step 2. Try a risk tolerance quiz. Many brokers and financial websites offer free quizzes. They'll ask about your goals, habits, and emotions, then give you a score. Step 3. Watch your reactions. The next time the market moves, notice how you feel. Did you panic? Were you curious? Did you want to invest more? That emotional reaction is pure gold. It's your real risk tolerance showing itself. Section 6. Matching investments to your risk tolerance. Now the big question. How do you apply this? Let's say you're a moderate risk investor. You might choose 60% stocks, some growth, some value, 30% bonds, 10% cash or gold, a conservative investor. Maybe 20% stocks, 50% bonds, 30% cash or CDs, aggressive. You might go 80-100% stocks, crypto, real estate, high growth sectors. The secret is this: when your investments match your risk tolerance, you don't panic. You feel aligned. You trust your strategy. And you stay consistent, which is what really builds wealth. Section 7. Can risk tolerance change over time? Absolutely. Life changes, so should your approach. Maybe you're single now and willing to take big swings, but in 5 years, with a mortgage and kids, you might want more stability. Or maybe you get a big promotion and feel more confident taking risks. The key: review your risk tolerance every 1 to 2 years. Ask yourself, have my goals changed? Has my lifestyle changed? Am I still comfortable with the ride I'm on? If not, it's okay to adjust. Section 8. Common mistakes to avoid. Mistake number 1. Following trends instead of your comfort level. Just because everyone's investing in crypto doesn't mean you should. Mistake number 2. Ignoring your emotions. If you're constantly anxious about your investments, something is off. Mistake number 3. Thinking higher risk always means higher reward. It can, but it also means higher chances of losses. Mistake number 4. Never reassessing your strategy. Your plan isn't set in stone. It should evolve with you. So let's wrap it up. Risk tolerance isn't just a financial concept. It's a mirror showing how you think, feel, and act with money. When you understand it, you invest with confidence. You stop chasing trends. You stop panicking at every market dip. And you start building wealth that actually feels right for you. Whether you're a cautious turtle or a bold lion, just know your nature. That's how you win the money game. Did this video help you understand your risk tolerance? Let us know in the comments. Would you call yourself conservative, moderate, or aggressive? And don't forget to like, subscribe, and turn on the bell for more smart money tips like this every week. Thanks for watching. And remember, smart investing starts with knowing yourself.